We're looking at a report on HIMS and HERS health, specifically its nearly 9% surge.
Right. HIMS rips higher. It's a really solid piece, and it correctly identifies the key factors: the buyback, the huge short interest, and the policy tailwinds.
It does. The analysis is timely, it has all the right ingredients, but I think we see a few critical opportunities to really tighten the causality and sharpen the risk profile.
I agree completely. To take it from a good analysis to a truly definitive one. The data is compelling, but it's about how we connect the dots. We need to be surgical about what caused that single-day move.
Exactly. Differentiating between the long-term story and the short-term heat. So, let's dive right in with the immediate drivers of that 9% spike.
Let's do it.
Okay, so the policy tailwind driver needs a more explicit quantification of its impact on HIMS specifically. To fully justify including it as a primary catalyst for that 9% move in one day. The material mentions the White House preparing an ACA subsidy extension.
And it notes that HIMS rallied with other healthcare stocks.
Which is true. But that linkage feels, well, it's an issue of scale and immediacy, isn't it?
It is. You have to ask the question, how does a potential policy change, something that affects the whole sector and takes months to play out?
How does that provide 9% of fuel for a direct-to-consumer platform on one specific day?
Exactly. Now, I see the author's intent. They're trying to build this narrative of multiple, comprehensive tailwinds pushing the stock up.
Which is a good narrative instinct. But when you place that broad, slow-moving polishing idea next to the raw mechanical pressure of a $250 million share buyback.
Which is an immediate floor under the stock.
Yes. The policy suddenly feels vastly overweighted as an immediate cause for that spike.
It really risks confusing momentum with mechanics. I mean, that buyback is management screaming that the stock is undervalued. And you pair that with, 33 to 37% short interest?
It's a staggering number.
That's a cocktail ready to ignite. The short interest is the fuel, it's the volume, it's the forced buying. In that scenario, the policy is it's background music.
So the core weakness here is that the analysis doesn't establish that direct, quantifiable causal link. It doesn't show how that broad policy immediately helps HIMS's bottom line.
Precisely. Which brings us to the suggestion. You've got to recalibrate the weighting of these short-term catalysts. Or if you want to keep policy in there as a primary driver.
You have to do the work. You have to connect it directly to the P&L, not just to general market sentiment.
Yes. So let's get concrete on that. One path for the author, if they really want to keep policy front and center,
is to explicitly show how enhanced ACA subsidies might reduce their customer acquisition cost, their CAC, or how it immediately expands their addressable market.
You need a number, even a projection, something that shows an immediate operational impact.
Right. And if you can't do that,
then I think the more robust option is to just reframe it. Except that the policy tailwind is a long-term sustainability factor. It's why HIMS is a good long-term hold.
And then you position the buyback authorization, that's the mechanical floor, and the high short squeeze potential as the real dominant immediate drivers.
Exactly. That's what created the volume and the heat on November 24th. It sharpens the entire analysis. It's about focusing on the forest fire, not the slow climate change behind it.
That pivot really elevates the whole argument. Okay, so let's move on to what a lot of the institutional shorts are actually betting on. The big one, compounded GLP-1s.
This is where the report has a chance to really dig in. I mean, given that the secret weapon of compounded GLP-1s is the core growth engine.
Then the regulatory risk that comes with it needs a much more robust exploration. You have to balance the bullish case against that very real institutional skepticism.
And the piece does acknowledge it. It mentions the controversy, the risk of an FDA crackdown, calling it a major blow.
It does, but that vital risk assessment is basically a single concluding sentence. It's just tacked on at the end.
And that's the weakness. I mean, that lack of depth completely overlooks the main market dynamic here. That 33 to 37% short interest isn't betting against weight loss drugs in general.
No.
It is specifically betting against the long-term legality and viability of HIMS's compounding strategy. It's the entire bear thesis.
So if the report doesn't dedicate real space to analyzing that uncertainty, it's essentially ignoring the other side of the trade. It's the elephant in the room.
A knowledgeable reader is looking for that. They expect you to address it head-on. So the suggestion here is to really expand that section. Give readers a framework for actually evaluating the likelihood and the potential impact of a regulatory challenge.
You have to align the risk analysis with the weight that you give the GLP-1 demand driver.
Exactly. And the author has great material to work with to kind of, mitigate that risk perception. We know HIMS management isn't just sitting on their hands.
Right, they're actively trying to reshape the narrative, move away from being seen as just a cheap pill dispenser.
Which brings us to their recent launch of labs.
That's a huge piece of their mitigation strategy.
A massive operational pivot that the report should absolutely explore in detail. The author could discuss how Labs positions HIMS as a comprehensive provider that's tracking vitals, tracking health data.
Which moves them beyond just being a pill pusher.
It's a direct attempt by management to bolster their case for clinical oversight, for regulatory compliance. They're basically arguing that they provide the clinical rigor needed to dispense these medications responsibly.
That shows a forward-thinking response to the pressure. Another really powerful way to do this, to take it from just a generic warning to actual analysis, would be to introduce a risk sensitivity model.
Oh, I love that idea.
Yes. For the reader who really wants to understand the scale of the risk, the report should ask the question:
If the GLP-1 segment, the engine heating up the stock, were to be partially restricted, what's the actual projected impact? Exactly. What is the revenue loss? And, crucially, how does that impact the company's valuation? I mean, it's currently trading at a pretty low price to sales of about 2.9x for 50% growth. How does that number change?
Quantifying the downside like that completely changes the tone. It proves the author has really thought through the bear case.
It moves you from saying, this is a risk, to calculating, this is the potential cost of the risk. And that's so much more useful for an investment thesis.
Absolutely. Okay, let's turn to the last key area, which is really about presentation and narrative control in the financial section. The report has these fantastic growth numbers.
49% revenue growth, record EBITDA.
But the way the section is structured, it just slightly blunts the impact. To maximize the impact of those bullish metrics, the material should proactively address and neutralize the Q3 EPS miss.
Frame it as a strategic trade-off for scale, right? Instead of just introducing it as this isolated bear case footnote at the end.
Exactly. The current structure, the financial heat check, lists all the great stuff first. The revenue growth, 2 million subscribers. Then it introduces the weakness, the slight margin contraction, and that EPS miss, 6 cents versus 10 expected.
So the last thing the reader sees is the negative data point. The author's kind of losing control of the narrative momentum right at the end. It leaves that miss just hanging in the air.
The weakness isn't the miss itself, it's the placement. So the suggestion is to integrate the context for that margin contraction much earlier. Shape how the reader interprets it.
Position it as the necessary cost of this big, successful transition into the lower margin GLP-1 segment.
This is a classic case of strategic storytelling. The company is making a conscious choice here. They're prioritizing rapid scale in a massive new market over, temporary margin optimization.
That pivot from high-margin generics to these complex, lower-margin treatments was designed to slightly depress the gross margin percentage. It was expected.
So the author needs to tell the reader then, say, this margin dip is intentional, and there are concrete ways to do it. For example, right after you mentioned the 49% revenue beat,
you immediately introduce the margin contraction. Explain that it's because of the lower margin profile of the new weight loss shots. This is the planned cost of the pivot.
And this is the key, you immediately pivot again to the proof of their efficiency. The 53% year-over-year growth in adjusted EBITDA, hitting $78 million.
That's the counterpunch. It shows that management is managing costs efficiently despite the planned lower gross margin from this huge strategic shift.
You explain the cost, then you immediately demonstrate control. That sequence completely transforms the perceived weakness of the margin dip into evidence of efficient execution.
And to really land it, you explicitly link that strategic pivot from the old services to the new weight loss segment as the necessary context for the temporary EPS variance.
It confirms the EPS miss isn't an operational failure. It's an investment in securing future, high-value revenue and market dominance.
And when you reframe it like that, the bull case just becomes so much more robust. It's much harder for bears to attack using that one earnings figure.
This has been a really productive session. Let's just quickly recap the 3 key actionable areas to strengthen this HIMS analysis.
Okay. First, refine the causal links for that 9% surge. Tighten the focus on the immediate mechanical short squeeze and the buyback. Either quantify the ACA policy's impact or reframe it as a long-term benefit.
Second, build out that regulatory risk analysis. Address the institutional skepticism head-on. That means exploring the compounded GLP-1 risk, using a risk sensitivity model, and detailing management's mitigation strategies, like the labs launch.
And third, take control of the financial narrative. Integrate the strategic cost and margin discussion up front to neutralize that EPS miss. Show that the margin dip is a planned and efficiently managed part of their massive growth pivot.
Implementing these suggestions will really elevate this report from strong market commentary to a truly comprehensive, defensible investment analysis. We encourage the listener to make these revisions and submit their updated work.
We look forward to seeing the sharpened arguments.